Welcome to The Explainer. Today, we're absolutely removing the guesswork and laying out the definitive, step-by-step blueprint for building wealth with just your very first $1,000. Look, if you've ever wondered exactly how to put your money to work, but honestly just felt completely overwhelmed by all the financial jargon out there, you are in the exact right place. We're going to keep this incredibly straightforward. Okay, let's dive into this right off the bat with a fascinating number from our sources, $17,250. If you had taken $10,000 exactly 5 years ago and just dropped it into a simple S&P 500 index fund, which, by the way, just bundles together the 500 largest U.S. companies, that is exactly what it would have quietly grown to by early 2026. And the crazy part? This wasn't from picking hot stocks. There was zero day trading, no expensive financial advisors involved, just your money sitting quietly in a simple fund, doing all the heavy lifting for you while you slept. But here's the reality check for most of us. What if you don't happen to have 10 grand just lying around? What if you're starting with just $1,000? Maybe it's a tax refund or money from a weekend side hustle. Well, the brilliant part is that the percentage return, the mathematical growth, and most importantly, the actual investing habit itself, they are totally 100% identical whether you start with $10,000 or $1,000. It's the absolute perfect starting block. So, to get you there without any of the usual stress, we're going to follow a really clean 6-step sequential blueprint today to completely demystify how to put your money to work. We'll be hitting the debt hurdle, picking the right account, what to actually buy, the power of automation, mistakes to avoid, and finally, your weekly action plan. All right, step 1, the debt hurdle. We really need to clear this boss fight first. And this brilliantly illustrates exactly why we have to start here. Before we even talk about opening up a brokerage app, we have to address the most common beginner roadblock. Paying off high-interest credit card debt isn't just some boring chore. Tackling it is actually the most empowering financial move you can make right out of the gate. See, historically, the S&P 500 has averaged about a 10% annual return over time, or about 7% when you adjust for inflation. That's a fantastic wealth builder. But on the flip side, if you're carrying a credit card balance, you are likely losing 21 cents on every single dollar, every year, to interest. So paying off an 18 to 22% credit card, that is a guaranteed 21% return on your money. Literally no stock market investment on the planet can reliably beat that. Clearing this debt is your first true investment. Now, actually, scratch that. Our sources point out there is one major exception to this debt rule. If your employer offers a 401k match, let's say it's a 50 or 100% match up to a certain amount, you want to always contribute enough to capture that match immediately, even if you are still paying down credit card debt. Why? Because that match is an instant 50 to 100% return on your money. It's totally unbeatable. So capture the match, kill the high interest debt, and then you are ready for the next phase. Step 2, pick the right account. Because honestly, where your money lives really matters. So the crucial point is this. Before you buy a single share of anything, you have to decide where to house it. Over a 30-year investing horizon, your tax burden is going to be one of the absolute biggest factors in determining your final wealth number. For most beginners, the ultimate wealth container is the Roth IRA. Think of it as your secret advantage. You fund it with after-tax dollars, meaning money you've already paid taxes on from your paycheck, and from there, it grows completely tax-free. When you withdraw it in retirement, you pay zero taxes, not a single penny. For beginners setting up at trusted platforms like Fidelity, Charles Schwab, or Vanguard, this account is literally a zero-tax superpower. And the rules for 2026 make this highly accessible for almost everyone. If your income is under $150,000 for a single filer, or $236,000 if you're filing jointly, you can contribute up to $7,000 per year. So your starting $1,000 fits perfectly inside that limit. Now, quick side note. If you think you might need the flexibility to withdraw your money early without any penalties, a standard taxable brokerage account is a great backup option. Yes, you'll owe some capital gains taxes eventually, but hey, it's still infinitely better than not investing at all. Step 3, what to actually buy. Let's start building your core foundation. Okay, this is where you really have to ignore the noise. Ignore crypto for a second, ignore your coworker's random hot stock tip. For your first $1,000, you just want to buy one broad market index fund or ETF, an exchange-traded fund. This simply bundles hundreds or even thousands of top companies together into a single purchase. It gives you instant, massive diversification on day one. And what's really interesting about this is how simple your choices actually are. The source material highlights 3 top recommendations: VOO, which tracks the S&P 500, VTI, which covers the entire U.S. stock market, and FXAIX, which is a Fidelity 500 index fund. And notice that final detail, the expense ratio, 0.03%, or even 0.015%. That means you are paying mere pennies per year on every $1,000 invested. These 3 funds are essentially identical in what they do, they're incredibly diversified, and they're virtually free to own. The guiding philosophy here is perfectly captured by this quote from our source. Time beats timing. Staying invested matters more than getting the perfect entry point. For your very first $1,000, just keep it incredibly simple with one fund to build the habit. Financial advisors note that once your core foundation is fully established, you can absolutely carve out a 10 to 20% slice of your portfolio for individual stock plays later on. But right now, we're just pouring the concrete for the base.
Moving right along to step 4, the power of automation. It's time for the $83 snowball effect.
Listen, your initial $1,000 is literally just the starting line. The real secret to massive wealth, the exact thing that turns an okay retirement into a truly amazing one, is what you automate every single month afterward. I want you to focus on this highly achievable number, $83. That is less than a typical monthly gym membership. It's roughly the cost of skipping just one takeout dinner a week. Setting up an automatic transfer for $83 a month is the ultimate behavioral hack. You set it, you never have to think about it again, and it unlocks the magic of compound interest entirely in the background. Let's move to and see how this builds, because this visually proves the explosive power of what Albert Einstein reportedly called the most powerful force in the universe. $1,000 left completely untouched in an S&P 500 ETF for 30 years historically grows to about $17,000, which, hey, is not bad at all. But if you take that exact same $1,000 and just add that automated $83 a month, your portfolio leaps to over $200,000. That is the snowball effect in action, and it's absolutely wild. Step 5, mistakes to avoid. Let's talk about dodging the beginner landmines. Of course, this journey isn't without its risks. It's absolutely crucial to protect your newly built financial foundation from the common, costly pitfalls that can easily set you back years if you aren't paying attention. Let's rapid fire through these traps. First up, buying individual stocks blindly as your very first move. Remember, one bad stock pick can completely wipe out a tiny beginner account. Build the index fund foundation first. Second, trying to time the market. Sitting on the sidelines waiting for a dip usually means you miss the market's absolute best performing days. Third, starting with volatile crypto. We all saw 2022's crashes, like Terra Luna going literally to zero, and it proves that extreme volatility is not where your foundational $1,000 belongs. And finally, paying high fees. A 1% fee sounds tiny, right? But over 30 years, it will silently steal tens of thousands of dollars of your hard-earned compounding.
Which brings us to step 6, your weekly action plan, the ultimate 6-step playbook. So how do we put all of this together into something you can actually go do today? Well, we've summarized everything from this explainer into a beautifully simple, straightforward checklist you can execute the minute we wrap up. This is the perfect moment to take a screenshot. Step 1, clear any credit card debt over 15%. Step 2, open a Roth IRA of Fidelity or Schwab. Step 3, transfer your $1,000 or whatever starting amount you're working with. Step 4, buy a single low-cost broad index fund like VOO, VTI, or FXAIX. Step 5, automate at least $50 to $83 a month to transfer right on your payday. And step 6, don't touch it. Just check in once a year. Remember, in investing, boring wins. Early, consistent action will always beat trying to outsmart the system. And that leads us to our final provocative thought for the day. The single biggest factor in wealth building isn't picking the perfect stock. It's not even how much money you start with. It's how early you start. Every single year you wait is lost compounding that you can never, ever get back. So you've got to ask yourself, what is your $1,000 doing right now? Time is your biggest asset, and $1,000 is absolutely enough to begin. Take action, start your journey today. Thank you so much for joining me for this explainer, and I'll catch you in the next one.